Welcome back to the Millionaire Choice Show. And on the show today, we have got Lior Gantz. He's a new friend of mine. I just met him, honestly, but I've been really impressed in the little bit of time I've gotten to know him. And he is the founder of wealthresearchgroup.com. And man, does he have a story for you about finance that he's about to tell. And I'm excited for him to be able to share that. Lior is a millionaire. And so you are talking to a millionaire, and he's 36 years old. So this is going to be a great story for you guys today. Lior, welcome to the show.
Thank you. Thank you for having me.
Yeah. So you were just sharing with me. Now you're in Tel Aviv, Israel, right?
Yes.
Yeah. Now, how long have you lived there your whole life?
Most of my life, except for the past 2 years, where me and my wife and my daughter, now 4 years old, but she was 2 back then, we took a 2-year round the world adventure while building the business and working and everything. But it was obviously cut off in February because of the virus. But yeah, apart from those 2 years, mostly in Israel.
Yeah. Now, would that have been a 3-year around the trip deal, or it got cut short by a year? Or?
I don't know. It would have been until we probably until the second pregnancy.
Oh, wow. So, yeah, so I loved your story you were sharing with me a little bit earlier. So I want to start there with the audience. So, because you started your millionaire journey as a teenager, and I didn't start my millionaire journey till I was 25 years old. And so you got started a little bit sooner than I did, and you reached your goal a little bit sooner. You know, I tell the audience and listeners, all the future millionaires listening, you know, I became a millionaire at 40, and I thought that was pretty good until I started meeting all these people who did it by age 30. And then all of a sudden I didn't feel so special. The reality is everybody starts the journey at different ages, but you started yours at 13. So why don't we share that?
Sure. So the journey basically starts because of a tragedy. My dad's business, when I was 13, his business went under. And that basically got me into working for myself a little bit in the neighborhood. I did babysitting. And then I convinced some of the parents that I could teach their kids, especially if they were male kids, some basketball. I painted decks and handed out flyers and whatnot. But the cool thing is I saved a bunch of that money. And by the time I'm 16, I have around $20,000 saved up.
Let's not gloss over that. You were $20,000 as a 16-year-old.
Yes. Yeah. No. I was literally, finishing school, and then for 5-6 hours, I was like working every day. Like had no alone, like from 4 to 5 until 10 p.m. Every day doing something, and in 3 years that saves up. So with that in mind, what happened was it was around June of 2000, if I'm not mistaken with the dates, and the banker that sees my account, he says like, what's going on here? And then you can have that money working for you. He introduced me to that concept, right? And I said, what do you mean? He says, well, this is what a mutual fund is, and this is the 2000s, so mutual funds were like ETFs or something. And he says, get your parents here, get to the branch, they'll sign a waiver because you're a minor, and you can start trading, equities, etc. So I did that. I got them there, and that's how I got started investing, basically, very early. 2 years later, my dad failed with his second business, and that got me really interesting because I was reading like 100 books a year. From 16 to 18, I was like reading Warren Buffett, Peter, anything that I can get my hands on in terms of investing. This is really early on, like with the internet. I had to, and there are not a lot of books that are translated to Hebrew, so I had to get them from abroad. And anyways, I started reading about entrepreneurship and business because I was like, why is this happening twice in 5 years? This is insane. And so got me into business and entrepreneurship. And over the years, between 2000 and 2008, I'm in my 20s, I'm building businesses, and then America goes bust and real estate's on sale. And I focus a lot of the time on real estate in those opportunity years between 2008 and 2012, I would say. And then by the time 2016, I realized, by 2016, I realized that, hey, Tony, I'm speaking to other people my age, younger. I'm speaking to people older. I'm speaking to people that are successful at what they do, very successful. And unless they are personally in the game of money, unless they are really in the game of either stocks or real estate, they don't know anything about it. If they're a professional engineer or a doctor, or I realize not that they don't know anything about it, but they have very little information on it in general. Now, did I find people that do a lot of research? Sure. But I understood that there was a big gap between what I knew and what other people knew. And I found that fascinating because, we're talking about money stuff, things that are important. And that's how wealthresearchgroup.com or Wealth Research Group, the free financial newsletter, was born. Because I was like, there's a gap here. And if people would know better about how the system works, 2, what to do about it, and 3, maybe there's some value to sharing what I do personally, then there's something to write about. And that's what's been happening basically in the last 5 years with the newsletter. I know you told me, you tell people to buy gold. When we founded the newsletter, literally this was like February or March of 2016. The first thing we said was, we believe gold has bottomed, and it bottomed like 2 months previously. Before that, in December 2015, and you should be investing in gold. And then 2017 comes along. We profile Bitcoin at like $400. Ethereum. I'll never forget this. In March of 2017, in our newsletter, we said, look at Ethereum. It was $12 a coin and went to $1,000 a coin in 6 months, like an 80-fold move. So we try to combine like what's going on in the broad economy, what's going on with the stock market, and what are we personally doing, me and my partners, with regards to our own investing. And then we flip it to you. Do your own research, do your own due diligence. Think if this is within your risk tolerance, within your expertise, et cetera, et cetera.
Yeah, I love the way you're talking about that, because when I started the financial game back when I was 25 years old, I did a lot of my own learning. And then got in with some other people who were very narrow-minded in the way they thought about, finances. And so I narrowed my focus pretty much down to mutual funds for a season for about 15 years, which I regret. I regret narrowing that focus that much. I think for some people, something simple like a mutual fund is a way to go, but it's also very restrictive. And I tell people, and I've said it on the show before, the best stock advice I ever got was from my wife, who knows nothing about money, but she knew something about product and users. And she recommended for me to buy Apple stock at $3 a share. She'll tell me that she actually recommended a few years before that when it was $1 a share. But I deny that one, and I just remembered at 3. But over the next course of years, it went up something like 140x. So it was like 14,000%. That it increased, and that's when you start looking at, hey, $10,000 became 14 million or $1.4 million. 10,000 became 1.4 million over about a 17-year span. And what you're talking about with Ethereum, and I just missed it at that. So I came a little bit late. I got in at about 365, and it went up to about 1,400 at its peak. Right. And so, yeah, but if I'd have been listening to you and been on your newsletter, I probably, knowing where I'm rethinking, changing my thoughts, getting away from the mutual funds only mindset, but looking at different opportunities, open up your mind to just learning. Like you said, you started reading 100 books a year on finance at age, 13, 16, between your 13 and your 20s and into your 20s. And that's millionaire key number 3, which is get money smart in my book. And you got to start, right? So everybody starts at the same place, knowing absolutely nothing. You started knowing nothing, but you started learning, at age 13 to 16, where you're like, hey, I need to learn about this money game thing. And you educated yourself on it. And then now, millionaire. When did you become a millionaire, actually? Do you have an actual
2 years
date?
ago.
2 years. So you're 34.
You know what? I need to figure that out. I need to figure out the actual date. That's an interesting one.
Yeah, so I mean that's a feather in your cap to go, hey, I was a millionaire at age 34, and I think that brings a lot of credibility. You beat me by 6 years, but you also got started a lot sooner than I did. But I think that's a real potential. I love that.
There's also a big difference, in my opinion, between becoming a millionaire or whatever, and enjoying wealth. I think I've met a lot of people that are wealthy, but man, would I not trade with them ever. The price that they've paid and are paying for the wealth they have is just it's unrealistic in my opinion. So I also think that there's a quality component to this, not only to the end result but to the journey itself. I don't know if that it sounds stupid to a lot of people. Like, why do I care? I just want to get there, right? But I think there's a lot to that. And actually, if you, in my guiding principles in life, financial security is at the 12th spot. There's 11 things that if you master better, you'll have what I like to call total wealth. And when you do achieve millionaire status or whatever status you're looking for, whatever that goal is, you'll be able to handle it, because you've heard probably of all of these stories about people that either inherited it, won it with lottery or whatever, or NBA stars, NFL stars, whatever, who got that windfall, but they were not ready for all that money, and money actually became a curse to them. So I think it's like a package, if I can say it that way.
Oh yeah, I love what you're saying, and I say it in a different way. But for me, it's millionaire key number one, which is you got to build. If you want to build and keep wealth, you have to develop strong character. You can't keep wealth, build it and keep it if you don't have a strong character.
Yes.
And I think that's what you're saying. But you also, I love what you said there too. I've never heard it put that way before. But you've got 11 other priorities that come before money. Money's like in your 12th priority. So,
okay.
and I really believe that. Money is not something you need to chase. It's something that you just need to make the right life and financial choices so that money chases you. It kind of comes naturally as part of your life versus you like making it a priority to pursue it. And I love how you said it. Now, you said it was a list of 12 things. Do you have that like in a like a structure? Do you call that like my 12 list of life's most precious things, or what is it? What do you call it?
I do. I call it my total wealth guiding principles. We're actually going to publish the entire list in the first week of January on our newsletter, like as a PDF, and on the website. It's going to be called Total Wealth. So you're welcome to get that. Depending on when you see this, you can actually go to Wealth Research. If it's not there when you listen to this, it's just because we haven't finished it yet. But if you go to wealthresearchgroup.com/total, you'll be able to download the entire thing and just browse through it and either accept or reject it or whatever. But we're going to publish it because we've been like dripping the principles in the newsletter one at a time, and now we're up to the 10th. So it's literally in a matter of a week or so that this is going to be up and running.
Yeah, I love it. And so your daughter, I think you said daughter, right? 4 years old?
Now, 4.5 now, yeah.
4.5. So have you started transferring money principles to her yet, or you have a plan for that? Because you got a future millionaire there, that little girl.
Yeah. Yes. Unless we do something foolish. But I think I've started to do a few things. One is to tell her, hey, Dad, because I work mostly from home. So Daddy's now working on the business, like Daddy's in the business. So that's one thing. She knows that there's a component of my life where I look to do things. Secondly, I explain to her, like I let her handle, like if I go to the butcher or whatever, I give her the credit card or the notes, and I tell her, why don't you pay? And we're paying him because he's bringing us goods. So I'm trying to like drip it in, but not like give her like the whole spiel of it. Just trying to introduce her to things that to us seem so obvious, but I want her to understand them consciously, because nobody's ever explained these things consciously. When I was a kid, nobody explains, hey, there's a guy, he wakes up in the morning, he goes and opens his shop, he does all these things so you can get fresh bread. Nobody explained that to me. This is a shop, go there, or this is a electrical socket, open it up, there'll be light. Trying to give her a little bit of the backdrop about it. I think it brings a lot of imagination to her, because she's like, okay, what can I do? How can I wake up in the morning and do something for other people as well? So I think that's important. We also have a piggy bank for her so she can understand that. But we also tell her, hey, that money you need to do, what are you going to do with it? We're asking like questions about it, but really easy. I think it's more important for me that she now develops in terms of speech and reading and writing. I think those are the 21st century's top priorities for somebody to do what we do right now, to speak and not be afraid that this goes out to thousands. I know, 10,000s. You probably know better than I do.
A few.
Yeah, a few thousand people. Not to be afraid to speak that, or to be afraid to actually to share your thoughts with many people. And then if you can say ordinary things in a powerful way, that is, in my opinion, the key.
Yeah, being able to communicate. I think that's a great lesson, because I don't think I understood that lesson until it was later in my corporate life, my corporate career, where I was on a board of directors as a CIO and COO. But just learning how to communicate effectively the way people need to be heard. They need to hear that message. And that just plays out in so many different ways, whether that's with your kids, with your wife, with your friends, with people you're trying to communicate powerful ideas to. And it's a skill. It's a skill you have to develop. Just like if you're playing baseball, you're going to be really bad at it unless you practice it. If in my case, it's soccer. It took me a while to get there. I started a late bloomer, but worked really hard at it until I developed proficiency. And your job skills or your life skills are very similar to that. And communication, in my mind, communication is probably one of the top 5 things you ought to develop if you want to be successful, for sure.
I agree.
And so let's turn the corner a minute. We got about 25, 30 minutes left in the show. You've done quite a bit. Like, it sounds like you've dabbled with investments in a lot of different ways. So sometimes you get into like Robert Kiyosaki, who is a real estate guy. Robert really talks about, hey, buy Bitcoin, buy gold, and buy real estate. That's his approach. That's what he goes down. Dave Ramsey is buy mutual funds and pay your house off early. 15% in retirement. So each kind of financial teacher kind of has their own angle. It sounds like you kind of like dabble in a lot of different things. So let's hit a couple of those. What are some of your favorite things that you've done with your money to kind of build your wealth and become a millionaire?
I think what's really valuable that I can bring to a lot of your listeners is, let's separate this between people that are listening and are accredited investors and people that are listening that are not accredited. I think the more time you have, in other words, the less valuable your time is, the more you're on your starter journey, the more you can spend time looking for specific investments and opportunities. The more you move on to the other side of the scale, I think it is much better to spend your time hunting for talented people than hunting for investments. I have been able to hunt the funds or the fund managers that I want managing my real estate and my stocks a lot. That's where I devote like 90% of my time. Instead of me, what I did like in 2008-9, Tony, where I was like driving around whatever city in America was made sense at that time, and just trying to find a house under the radar, off market, blah blah blah, talking to a gazillion realtors trying to find those deals. That is not what I can do anymore. That's not the way I can structure my life. Now I'm more looking at, where's a fund that has done a compounded return of 15% a year for 20 more years, still run by the same people, and I can get in there. And then it's a question of, will they accept a person like me, where they can obviously get a lot of pension fund money and whatever else? Can I squeeze myself in there? What can I offer these people that will do that for me? And if you're non-accredited, If you're driving an Uber right now, or you're a waitress, or you're starting out, you can do the same thing I do, but then you have to, because you're not going to be able to invest it. You have to find a Tony Bradshaw and tell Tony, look what I found for you. Let me match you with these people. I've done a lot of the legwork. Give me some sweat equity. And then you get into that network of people. I would say in our world where you have the haves and have-nots, if you don't have a genius idea on how to build your own business right now, then your genius idea should be to find wealthy people and to ask them to understand the game of money better than them, because that's really easy to do. Literally, that is doable. There are a lot of people that are able to learn in theory, about real estate, about stocks, more than somebody who's a full-time CEO and just doesn't have the time to do it. And then find funds. It's a time-consuming proposition, and then you match them. I think that there's a lot of sense into that. So if you're an accredited investor, I would say hunt, network. That's where your real value is at. You can network, you'll find one fund that can, compound your money for the next few decades. You're done. You don't need to make that hard. And then if you're not accredited, find that fund, find a rich person that wants to invest and trusts you, build trust with them. And then that's where you can get started and building your wealth, because somebody has 10 or 15 or 20 million that he's ready to put with you, and you're working on a sweat equity, let's say of 1% a year, 2% a year, you can do the math yourself. You're not going to be able to do that kind of stuff. And man, that person, if you're good with him, well, Tony will tell Lior will tell, and you will have a network. So I think networking in this economy, in this have and have not economy, networking and hunting talent where you can bring value to that fund and bring value to your clientele, so to speak, that makes sense to me. I would say if people were bringing me that, I would look at what they have to say. So that's one thing. I think the way I look at investments in general is I want to have about 24 months worth of my living expenses, my burn rate in physical precious metals first and foremost. So let's say the family spends about $5,000 a month, just to make that easy. 24 months is 24 times 5,000. That's $120,000. You take that money, take that fiat currency, convert it to physical gold and silver. If there's a 2-year depression, if there's a 2-year anything, that's your start over fund right there. You've got 2 years worth of your income. In a depression, that will probably be worth 3 or 4 years. And if there's like a reset or an inflationary crisis, a deflationary, whatever you want to call it, whatever the Armageddon that people on like Kiyosaki are talking about, etc., you're good. In my opinion, 2 years, you can do more, but 2 years, and there's little downside to it. In the past 20 years, if you, for example, go to wealthresearch.com/gold playbook, that's a PDF we put together about gold investing. You'll see that in the last 20 years, gold has done better than the S&P 500. It's done better than the NASDAQ, even though the NASDAQ has been on a tear in the last year. So there's no downside to this. This is not like holding cash at all. Mm-hmm. Okay, you got that covered. I think then it's a choice between how old you are and how much you're looking for passive income. If you're looking for more passive income, be more on the side of real estate. If you're looking for, hey, I'm young, I have a great income from my steady, career or business, then do more stocks, in my opinion, because those compound faster over the years. They provide little smaller, passive income by way of dividends and whatnot. But on the flip side, when you're 60, you'll have much more equity. So that is the lion's share of the portfolio, real estate and stocks. And then I think there's a bit of money that you need to put in there that is called life changing, or it doesn't make sense to me not to take about 10% and put it in things that man, I can say, like, I can tell somebody, you know, I put some seed money into whatever TikTok, or I put some seed money in there, put like 15K there, and it's now worth like 4 million. You change your life, you know what I mean? So to me, putting some life-changing money in there, where, you know, that 10,000 could go to zero, fine, because what is that going to do? It's going to take, if you have a net worth of $1 million, then it's going to wipe out like 100,000 of it. That's fine. It's fine, because the reward, that 100,000, it sets you on a different path in life, because you go into that stratosphere of you remember the guy who painted the walls for Facebook when it was private, and they gave him like they told him, you want $250 for painting these walls, or like 4,000 shares? Like, I'll take 4,000 shares. And like 6 years later, those were worth $250 million. Now, you can Google that story. It's real. I don't know if the 4,000 shares is true. I just said that for
some number. Yeah.
But no, but the 250 million, I think, is accurate.
The richest. Yeah. He needs to write the book, The Richest Janitor in the World. Or the richest wall painter.
He was a known artist. So they brought him there because he was known. But
he wasn't painting rooms then. He was painting murals or something.
Yeah, he was like artistic, Silicon Valley stuff.
Gotcha.
But anyways, that's how I think about it. And then
hold on a second. Save that thought. So pencil that down. But you're throwing so much info out there. I want to backtrack a little bit.
Okay.
Break it down for the millionaires listening. So I want to park on the first thing you talked about was gold, and then we'll hit on the other thing you talked about, which was investing in these other types of stocks and things like that. Okay. So for the average American is 70+% of Americans are living paycheck to paycheck. So you're throwing around numbers like, oh, you need 120 grand in precious metals. That's not something that's like real doable for the average American. That is doable for a millionaire like you and me, but it's not doable for the average. So let's break it down onto a level that's applicable. And, Dave Ramsey's done a great job of teaching people to develop a mutual fund, which is, 3 to 6 months living expenses. And what I've started telling people, because I do believe in gold and silver for a myriad of different reasons. I'm not necessarily like what people would call a gold bug, where you go out and start buying gold like crazy, but I have changed my thinking on that. That's something that's kind of a new evolution for me in the last couple of years. And so what I've been talking to people about doing is, even with those emergency funds where they have, 6 months of living expenses, about converting like 20% of that, because it's really difficult for somebody to make the mental shift to go, hey, I've got 6 months in cash sitting here, to like, I should convert all that. You're telling me I should convert all of that into gold? And that sounds like where you're at. So I want to try to bridge the gap between these two different thought processes. So what I'm telling people is, hey, if you've got 20 grand or 30 grand or 40 grand sitting in a cash account, I think you should strongly consider converting at least 20% of that into a precious metals, primarily gold, but some silver, if that's more affordable. I have both for various reasons, which we won't go down that road right now. But and the reason for that is, the average currency, and we're talking about the US dollar here, it's called the fiat currency. So every country has some kind of fiat paper currency. And that's really just another way of how I say it is fake money. It's just money that the only value it has is what we as Americans believe it has. And at some point, every fiat currency fails in history, right? And so if I remember the stats, I think the average fiat currency lasts about 75 years before it implodes with hyperinflation, or the country gets overthrown, or some kind of form of implosion happens to the currency.
Okay.
And the US currency now is going on roughly 200 years. And so we're way overdue for a currency implosion. And then it's been reset a couple of times in history. Our currency got reset, with the Great Depression. It got kind of reset again in the 70s when we came off the gold standard and went on what's called the petrodollar. And now, if you look at our currency, the overall value of the currency has lost I think 95% of its purchasing power due to inflation, right? What you could buy with $1 years ago, you can really no longer buy the same thing, like a loaf of bread, what it would buy. And So really for my listeners and the listeners is I do agree with what you're saying, which is buy gold. That should be a part of your financial thought process. Like when you go, hey, I'm going to buy mutual funds, you should also be thinking I need to buy gold. And I think that's a new teaching, and we've touched on that a couple times on the show, but not the way that you said it. You're the first one that said, hey, you should have 2 years worth of your living expenses all in gold. And so talk to the listener a little bit about what that means, like why you kind of touched on it briefly, but I think you say this all the time to people, so it's easy for you to gloss over to the high level. So why does that mean so much to you?
A couple of things. First of all, with that mutual funds, I don't invest in mutual funds. That was like what the banker in 20 years ago was like mutual funds, because that was very popular in those days. But with regards to your question, it's not that all of the cash savings are in precious metals. So what I said was, if you're looking for an added layer of protection in your life, if you're afraid of the mother of all black swan events, then figure out a number of months and then convert that into precious metals. You'll have a start over fund. If the US dollar for some reason loses its reserve currency status around the world, and follows that with losing like 30 or 40% of its purchasing power in a matter of a few years, like some hedge fund managers actually think in this decade, then the risk you have is your cash savings. Your pure cash savings can lose a lot of their power, but a precious metal savings vehicle will not lose that power. It will actually either stand with that inflation and mirror it, or do much better than that. So, and from 1971, like you said, from the 15th of August, 1971, when Nixon decoupled gold with its convertibility to the dollar, or the other way around, it was 35 an ounce. Today, it's 1900 an ounce. So a 60-fold, 55-fold move, that's more than what most other asset classes have done. So gold is an asset class that actually does better than inflation over time. I think gold does best when there's real negative interest rates. And what I mean by real is the nominal 10-year treasury bond is the barometer for all of the asset universe. All of these sovereign wealth funds, the hedge funds, the pension funds, all of the people that manage billions and even hundreds of billions and trillions, they all look at what a treasury bond for 10 years, what it yields, currently 0.8 or 0.9%, depending on when you're listening to this. And then that's where they judge everything else off of. So they would say, okay, that yields 0.9%. Okay, the S&P 500 dividend yield is 1.8%. Obviously, I should be in stocks, no matter what the P/E ratio is. And that's why the P/E ratios today are much higher than in the past. And couple that with the fact that the CPI is more than 1.4, 1.5%, then now you're saying to yourself, well, if I lend money to Washington at 0.9% for 10 years, I'm losing money, because inflation puts my real return at minus 0.6% or something like that. So what the government is telling you is, don't lend us money, you'll lose money. And that's why the Federal Reserve has to monetize all of this debt, because there's a lack of real buyers out there. They don't want, why would you buy it, right? Why would you lend money to Washington? So gold and silver do best when cash is giving you a negative real return. And by real, I mean after you calculate inflation into the mix. So that's one thing. That's why I give gold and silver a lot of value, okay? Because if you look at cash versus gold and silver beat it out, especially gold. This is not true all the time. It's true now, okay? Secondly, the dollar or the euro or the pound or whatever is only a measuring stick. If you have a If you own a share of Microsoft trading at $210 a share today, and tomorrow the dollar's gone, your Microsoft shares are going to be worth $0, but they're not going to be worth zero. They're not. You own a piece of Microsoft. They're going to be worth whatever somebody is willing to pay for them in other terms. They're going to be worth a tenth of an ounce of gold. So their real value is not going to change. It's going to change when you talk about how much it's worth in US dollars, but it's not going to really change. And so these people that are afraid constantly, they're living their lives with, you cannot have paper assets. All paper is worthless. You have to hold it in your hand, etc. It's not true. It's a myth. It's a myth. When you own Microsoft, you own a real thing. You own many real things. Or when you own whatever else, it doesn't matter. You own a paper notification that you own a piece of a real thing. And for the world to become so fraudulent that thing is going to be worthless, this is like it's like a World War III scenario. So anyways, I think it's really important to put that gold and silver away as a sort of an insurance policy, because it does well over time. But for the most part, you should be looking at investments that grow not because of inflation, but that grow because of their value plus inflation. So you're looking at either companies that have such a great product or service that they can raise their prices with inflation. So now you get that inflation buffer, but you also get the buffer that, hey, they just opened a new market, they just merged with this company, etc. So you get inflation plus the real organic value, which you don't get with precious metals. Same with real estate, but to a different degree. But again, if you're one of those people, like you said, where, hey, $120,000, what are you talking about? Like I have a few $1,000s or a few, tens of thousands. If that's the case, that's not the podcast you should be listening to. You should be looking at ways of one, how do I speed track or fast track my career? What's wrong with either the company I work for, or what's wrong with my skills that I can't get more money into my life? What value can I provide more? If that's the case and you're an employee, here's my advice. From this day forward, once a month, create a plan for your bosses and supervisors and whoever you have to get to in your company. If you have a shitty boss, then go above him. If you have a shitty boss above him, go to the regional, go to the national, whatever. Go wherever you need. Or if the company sucks, just shop yourself to another company. Once a month, build a plan with all of the problems that you've seen that month in your company, and here are solutions. I think we're losing customers between 2 and 4 because, our signs, they only lit up at 6 p.m. when you should light them up at 2. Doesn't matter. Find things, because your business that you work for is not perfect. What do you need to do to, and don't look for an immediate response like you're amazing, you get a promotion. Just do that, however long it takes until it gets notices. I encourage that with my own family members and with friends. Some of them, after 6 months, they reached a point where their boss said, I really want you to pitch that idea to like a regional supervisor, and they literally told him, tomorrow you stop doing what you do, you work this new project. And obviously that offered a lot of opportunity. I think that is what employees need to do. Mm-hmm. They need to always be proactive. In a good way with their boss. You have to put your boss on a limb, in other words. So that's if you're an employee.
Let's park on that just for a second. I think that's a great idea. So let's translate that, because I think I can see the same thing in my own career, where you're really creating value. That at the core, that's what you're doing, is you're creating more value in yourself for the employer, and you're bringing more value as an employee. So when you go take a job, it's sad, but you're kind of put into a box. And so there's an expectation of who you are as an employee just because of the job that you're taking. And so you almost have to reshape how your employer or your boss views you. And that's what you're talking about, is you're talking about bringing more value above the job that you're given. And when
way above.
Yeah. And when they start to see that, and it doesn't happen right away because they're not used to seeing that. They're used to putting you in a box. And so you're stuck inside of this box or this view that they have of you until something shifts. And you have to stick with that change. Like you're saying, you got to do it monthly. You're not going to see it you're not going to see immediate change, but after about 6 months, or it might take a year of that consistency, the opportunities will start to come to you. And I've seen that in my career pretty much on every job I've ever had. I just would not have phrased it the way you've said it. And some of that, I'm going to add one more layer of learning or principle on top of that, which is you have to invest in yourself. And you did that because you read 100 books in a year. I've never done that. I don't know that I've read 100 books in 5 years, but that's a lot of books, but you have to invest in yourself. I've invested in myself in different ways, when I started learning programming or coding. And, I told my wife, hey, we got to spend $1,000 to go buy this piece of software that's going to help me be able to program databases on the internet. And I'm like, this is what I want to go do. Let's go do it. But that was a way of investing in myself very early in my career. And you're talking about doing the same thing and paying off. So I love what you're saying, the strategy. How would you say that? Do you have like a phrase or a way that you kind of, a principle? Like, is there a name to that principle that you just?
I would say the best way to call it is to go above and beyond, in like in a manner that is non-compromising. So when you enter your workspace, you have to think only about that workspace. Like literally, you have to only think about. And the lower level job, the lower the job that you have, the more you'll be able to shine in contrast to your employees. Because most employees that are minimum wage and that area, they're disgruntled, and they don't think they'll be the CEO one day, and they'll probably won't be, but they can rise very fast. And this process of identifying things in your workplace that are bad, that has another value add. When you can find those, you can go to competitors and say, look, I've worked with this franchisee of Starbucks. I've worked with this McDonald's owner. Man, do they have it? Can I show you all of the things that they do wrong? Maybe there's commercial value to that. That's called the stowaway approach. You're getting paid to learn this guy's mistakes, and then you can take it and say, okay, man, is this a stupid protocol that or a non-effective protocol that these guys have in place? If I can just do 1, 2, 3, I think I can have a successful mechanic shop, whatever. So they market so badly online. They do this. There's so much value when you say, I am going to spend the next 8 hours, not just running this cappuccino machine, but looking at everything. Or I won't just spend this next 8 hours. I think that mindset of above and beyond, it just has value. That is, afterwards you take it home, you can apply it on your girlfriend, and you twist it, right? It's not a business, there's value to just that mindset, is what I'm saying.
I had to chuckle a little bit because after 22 years of marriage, I think I need to go above and beyond, right? And
true. So
yeah,
true.
always. Never forget that, you married people out there. You got to go be above and beyond for you people that are thinking about getting married. Never get lazy in your marriage, for sure. Well, we've got just a few more minutes. I want to switch gears to the other thing that you said, because this is a show about money. And one of the questions I'm getting a lot from the people that I'm coaching and helping is this principle of like, how do I invest? And for me, learning to do that at age 25, I figured out on my own, but I get that question a lot. Like, what do I do? What's next? How do I do this? And you really touched on a principle. So let's drill down into this. And you were talking about, the way I look at it is you have your safer investments that are, for some people that's going to be mutual funds. You said you don't invest in mutual funds, but you look for funds, but they're not necessarily mutual funds. They're like a managed fund or something like that.
Well, with real estate, with stocks, I do my own.
You do all your own stuff with stocks. Okay.
Mm-hmm.
Yeah. And then, but the principle that I've kind of picked up is I've started recreating the way that I invest. It's going back to my roots when I was 25. So for the future millionaires listening, when I started at 25, I was trading tech stocks and flipping my tech stocks every 6 to 9 months, making about 60 to 90%. I was investing in things like AMD and Cyrix, which is no longer around, and Intel and Dell and, all these tech stocks. That's what I was familiar with, and that's what I liked. So that's what I was trading. And then in my 30s, I stopped doing stock trades and started doing just mutual funds only and real estate, buying real estate. Okay. Now I've kind of come back full circle, and I'm going, okay, what does the next, 30 years of investing look like for Tony Bradshaw and his family? And what am I going to teach my kids? And I've kind of gone back to the stock piece again and going, okay, that was a 25-year-old guy who was learning about stocks and how he invested. Now I'm a 50-year-old millionaire. How am I going to invest in my stocks? And you've touched on it, which is if you invest 15 grand in a stock like Apple, which I used earlier in the show, the potential upside is unlimited, but the maximum loss that you're going to incur is what you put in. So, if I invest 10 grand, unless you exit. Yeah, unless you exit. So if you could lose it all, but you're going to lose 10 grand. But if you get it right, the upside is infinitely potential.
Yeah, an asymmetric bet.
Yeah. And so let's talk about that. So I'm going to let you explain, and maybe I'll jump in and kind of ad lib a little bit. But it sounds like you've already got that same approach that I'm kind of walking down these days.
Okay. I think the game or the art of investing is shifted, and now it's more about judgment than information. In other words, in the old days. When you listen to a Buffett or Charlie Munger or a 50 or 60 or 70-year-old, they grew up on the Great Depression, and their value investing, what they call value investing, is they're looking at something like a Tony Bradshaw studio, and they're like, okay, how much is the value of all of these books and the shelf and that couch and that mic? They're trying to find the liquidation value of that business and say, okay, that's the intrinsic value of the business. And I'm not willing to pay more than that. That is the Benjamin Graham approach. That approach is gone. In the days of the Great Depression, in the 30s and 40s, many businesses were selling for less than the liquidation cost. So you would buy that whole studio for a fifth of what it was really worth, because people were just liquidating business. And you would buy a business that's worth $1 million, and you would get like a $5 million cash account that it actually held. That's how value investing worked in the 30s and 40s. It doesn't happen anymore. And people were saying, I'm looking for these, things that are trading at, the P ratio of 5 or 4. They're mostly because they're going to be bankrupt tomorrow. So that approach has changed. And a testament to that is that Warren Buffett is underperforming the markets for like 20 years. Okay. So you have to think about that fact and look at the companies that made him rich. Look at the 16 companies that really made Warren Buffett rich. They're not equities. They were private companies when he bought them. He went and found private companies, either in his city or elsewhere, and that's what really made him rich, not the public stocks that he's bought. And so that's one thing that's important to remember about the godfather of investing and whatnot. So, and what he had then is the advantage that he could look at things for months, and other people would not even know about these companies. Today, the information is computerized. So, expect that everybody else knows about these stocks the same way as you do. Okay, all of these the information part is much more open. So you either find people that have more information, that have the ability to find more information than you do. That's what I say when I say look for hunt the people, hunt the talent, and not the opportunity. Okay, because that's going to be easier for you to find one person that has this amazing system for finding great opportunities. And secondly, I think the really key approach is to be a better judger of businesses. That's where your value is at. Judgment of what is a real competitive advantage. Is this a competitive advantage when somebody tells me about this company? Hey, look at what they have. The judgment that you can apply, the questions that you can apply, because literally buying stocks is like buying businesses. Are you going to be, when you look at a business, you have a bunch of questions you have to ask. People buy stocks like this today, and they sell them like this, like casino chips. It's not true. It's not the way to do it. So I think the key is one, look at companies that you can understand. Find 40, 50, 60, 100 companies, whatever it is that you look at, and you start to figure out a watch list. If you go to our website, to wealthresearchgroup.com, on the top menu, you'll see a button that says watch lists. These are 5 watch lists that we published from the March lows up until the last one was October. They hold a collective 50 companies in them. And we said, look, here are noted limit orders. Here are prices that we will buy these stocks if they reach them. Now, not all of them dropped to those limit orders, but each one that did, it represented between 3 or 4% of the bottom, because we've spent so many years understanding these companies, where the institutional money likes to support these companies and where the institutional money finds value in these, that whenever each of them gets to that point, there's so much support, the price starts to trend up again. So you can look at those and do your own research, but I think that is the key. Build a watch list of companies that you understand, that you realize, the asymmetric bet, like you're saying, the risks, and then the amazing rewards on the flip side, and then just be patient. Whenever they come down to those limit orders, I think that's a good time to be in them. And then I always like to match. So for every dollar that I put in a company, I like to put $1 in either the S&P 500 or the NASDAQ 100, like an index. So I match. Okay. If I put money in a given company, I also put that same amount in an index fund. So it ends up being that I have 50% in individual companies, 25% in the S&P 500, and 25% in the NASDAQ.
Yeah, I love that approach. And so that's a structure or framework that I think people can get their head around. And it's very similar to what I was doing at 25, but I was not adding in the NASDAQ. And just for sake of time, we won't go into the NASDAQ, the difference between the NASDAQ and the S&P index today, but maybe we'll have you back on and kind of dig down into these different stock exchanges a little bit more. But I love what you did when you're diversifying, because you're going, hey, I am willing to accept some risk in these high potential upside stocks. In this case, I'll throw Apple out there because that was one of my wife's choices. And she and I are going through a process just so she can understand investing better. But then also these safer bets that are going to get lower returns overall, but it's safe money. So if you are safer money, shall we say, so that if you do lose your butt on all these different stocks, you still have this little egg or this little nest egg that's still protected over here. And I think
can I say something just with regards to that?
Yeah, go for it.
I think just not to be confusing. Over the years, there have been very few situations of permanent loss where I've bought a security and it did not return to that price that I initially bought it. So I don't do a lot of risky. I may buy and it won't be the day of the bottom. It's fine. It turns out that the day of the bottom was 3 or 4 months down the road. Doesn't matter. The only issue is a permanent loss where the company just doesn't return to that price ever. Okay? So it's very important to realize that the day you think about a company is not the day that it's going to bottom. So I like to um, decide on an amount that I would invest in a company, and then I don't invest in that same day unless something specific happened. That's why I call it a game and an art, because there's no set rules. It's not black and white. But as a general rule, I would split my purchases along a time frame. Okay, just so people understand. They call it dollar cost averaging. I just call it being smart.
Smart investing.
Yeah.
Yeah. And I think that's a good point too, because I tend to go, yes, you can lose it all. But the reality is, like, I love what you said, is very few of these go to zero. If you were invested in Kmart, you pretty much went to zero. If you're invested in Sears, you pretty much went to zero. Enron was one, that imploded. General Motors.
The fact that you remember them just explains how so few there are of them. You know what I mean?
Yeah. And that's a good point too. And General Motors, which is an interesting one we were talking about on the show a while back, but I didn't think about this. But when the automotive crash happened and the government came in and bailed out General Motors, the creditors got paid. The people that General Motors owed debt to got paid, but the people who were invested in General Motors, stockholders, they had a complete loss of shareholder value because they were went into bankruptcy and lost all that. And so those are a few cases that happened, but the reality is you're not looking at a total loss for most of these stocks. What you might be looking at is what you're saying is you might look at an underperformance versus another stock.
Sure.
Like,
exactly.
Would your money have been better in an S&P index or a NASDAQ index fund versus an individual stock? That's the game you're playing. But, and I'm a firm believer now that the potential upside is such there that if you do it right, you've got to take the risk if you're ready. And so that's the thing. You started investing and learning about investing really early in your life, Lior. And, I started at age 25. And so it's not like as a new investor, as a new future millionaire that's listening to the show, that you have to think about starting there. That can be really scary. Hey, I need to go put, $10,000 of my money into these stocks that I don't really understand. That's not what we're saying. You got to start at the level that you're at today and then continue gaining knowledge until you're comfortable, until you're educated, until you're ready. And I'm going to plug for you right now, Leo, and let you clear out the thoughts. But Lior's got a newsletter. He's talked about it on the show already. But I'm going to strongly suggest you guys go and sign up for his newsletter. He's going to give you the URL in just a second. But I think he's going to be a great source of information for anybody listening to the show who wants to learn a little bit more about investing and making some good decisions. And like you said earlier, if you had gotten into Ethereum, if you like cryptocurrency and you want to learn about cryptocurrency, if you'd gotten to Ethereum when Lior told you to do it or told some people to do it, you would have been looking at 80 to 100 times your money in about a 12-month period or 18-month period. And you're not going to get that. And you're
just
not going to get that.
Just to be politically correct, we highlight certain things. We don't. You have to decide what you want to do.
Yeah, you highlight the opportunities. Yeah, that's a good way to say it.
Yeah, we highlight the opportunity. We even tell you if we're getting invested. I think a good exercise for people is to look at what's called the Dividend Aristocrats group. It's a group of about 54 companies that have paid a rising dividend for over a generation. So for 25 years or more, consistently every 4 quarters, they've been able to raise their dividend. To explain to people how important that is, if you bought, this is a real life example. If you bought a company called Vfcorp, not many people know Vfcorp. It's the largest manufacturer apparel company in the world. It owns Timberland, JohnSport, Lee, Wrangler. It owns all of them in like a parent company. I'm giving you that example because if you look, when I started in June of 2000, that company, I believe, was trading at about $6 a share with about 40 cents of a dividend. And the reason I give you that example is because I own that company still today. And if on that $6 that you paid for it, they now pay a dividend that's much more than 40 cents a share. Okay. So let's just, to make it easy, let's just say that from 40 cents a share, they've raised that dividend to $2 a share. Well, now your original purchase in the year 2000, when you purchased shares for $6 a share, now pay you every year $2. You're making a 33% return because their dividend over the past 20 years has increased 500%. That would be equivalent to buying a house in the year 2000 for $100,000. The renter was paying back then $1,000 in rents and now pays $5,000 in rents every month. So the value of the Dividend Aristocrat group is immense over time. And that's why I think when you look at that group of 54 companies, you'll see that they're all very well-known companies. I think it's a good exercise for people to look at them and just say, okay, this is going to be my first investment. Well, I can look at these companies because, man, no matter who was president, no matter what was happening in the world, no matter what was the interest rate, no matter Corona or this or that, they are able to raise their dividends every year. That means they have a real competitive advantage because a dividend is a mirror of your ability to pay ever bigger profits to the shareholders without losing your market grasp of what's going on in your industry. So those are a very unique group of companies. And obviously there's also an ETF. So you can buy the ETF for it, which I own. It's NOBL ETF. But anyways, what I'm saying is it's a great place to start looking at companies and understanding it, because for the most part, you probably know a lot of them.
Yeah, I think it's wonderful, Lior. So we're going to wrap up now. And how are people going to get on your newsletter list and learn more about your stuff? I know you mentioned the /gold playbook earlier. So yeah, let's just let people know how to contact you.
You go to the website. On the homepage, there's you can subscribe easily to the free newsletter. That's where you'll get about 3 pieces a week where we either talk general stuff or specific opportunities that we want to highlight. You can also, on the website, there's a top menu button. One is watch lists. You can download those, or the other one is called special reports. It's a wealth library of PDFs that you can pick and choose from: crypto, gold, and a lot of things.
Yeah, and that's wealthresearchgroup.com.
Exactly.
Awesome. And I think that's wonderful. I thank you for the knowledge you shared. I'm going to go look at a lot of this stuff myself. I had not heard of the Dividends Aristocrat group before. And so I like being real transparent on the show. So I've learned a lot from you today, and I appreciate your time.
Thank you very much.
All right, take care. Bye-bye.
Bye.
The Millionaire Choice Show shares the opinions and experiences of people and should not be considered financial advice. Before making your own financial choices, please seek out a registered financial advisor or certified financial planner.